ULTY is the YieldMax Ultra Option Strategy Income ETF. And we also have SLTY, the Ultra Short Option Income Strategy ETF, which is going to be the same strategy as ULTY, but it's going to be bearish on stocks. Now imagine if we had an ETF, the best of both worlds. In this video, we're going to be going over a new ETF that's coming out. This Form N-1A has been filed by NEOS ETFs to pretty much combine the strategies behind ULTY and SLTY into one single ETF. Now, a lot of people have been buying ULTY and SLTY to kind of counteract some of the NAV erosion that people have been experiencing in the market as of lately. But right now, it is a little bit hard to manage both of these ETFs. It's hard to watch when one does well and then the other one does not perform as well. And that is what this ETF by NEOS is going to do effectively. A lot of people are excited for this ETF. A lot of people are a huge fan of NEOS ETFs because of the popularity of ETFs such as QQQI, one of the best new ETFs, and has received an award for best new ETF by ETFs.com, which is absolutely amazing. It's one of my top holdings, in my opinion, for both growth and income potential. Now, if we take a look at SLTY and ULTY, we can see ULTY is around the $5 price point. So it's a very cheap ETF. And on the other hand, we have SLTY, which is at $42 per share. Now, in inception, this was a $50 ETF, but because the market has been doing well, stocks have been going up. And that's when this ETF really does not perform as well in bull markets. So we're seeing year to date, it's down almost 15% since inception. It's really not doing too good. And in my opinion, this isn't really an ETF that you want to buy and hold forever. You really have to time the market. If you feel like there's a little bit uncertainty in the market, that would be a good time to hedge your portfolio a little bit, buy some SLTY, and maybe if the market crashes, this ETF will rise and hopefully hedge your portfolio by counteracting those losses. But effectively, it's going to hold between 15 and 30 stocks in this ETF, and it's going to short those stocks. So you are going to be bearish on the underlyings. Take a look at the underlyings in SLTY. Are you bearish on those stocks? Make sure you're bearish. If not, don't invest in this ETF. And on the contrary, take a look at ULTY's holdings from time to time. Are you bullish on the companies in this portfolio? Because if the underlyings do well, this ETF is going to do well. And you do have to keep in mind that these ETFs hold very volatile companies, very speculative companies, in order to maximize premium, because it does have an 80% distribution rate, and it really has been paying out consistently about 9 to 10 cents every single week, which is the main reason why a lot of people buy ULTY. Now let's get back into the new kid on the block, which is NEOS ETF. We're not too sure what the ticker is going to be or the name. The name is actually going to be listed on this form right here, and it's going to be the NEOS Long/Short Equity Income ETF. So it's basically going to combine the two strategies of ULTY and SLTY into one ETF. And in my opinion, I'm pretty excited for this. A lot of people think this is going to kill off ULTY and going to kill off SLTY because NEOS has a great track record. If we take a look at some of their ETFs, such as QQQI, they have pretty good capital appreciation. As we can see, it's up 9% since inception, since February of 2024, as well as paying a 13 to 14% distribution rate. And it's been consistent in its payouts, paying between 50 and 60 cents per share every single month. Now, I would like to see a weekly payer from NEOS ETFs, but they have been doing pretty well with these monthly distributions. And in my opinion, monthly payouts are just okay. You definitely don't want those quarterly payouts. With a weekly or monthly payout frequency, you are better able to manage your expectations in terms of income month over month, as well as expenses that you need to allocate some funds for. So you're easier to pay off your bills if it's a weekly or monthly payout frequency. And another ETF that has had an amazing track record by NEOS ETFs is going to be the Bitcoin High Income ETF, BTCI. And this is up 21% since inception. So we can really see that these ETFs have capital appreciation as well as paying out high monthly distributions. Now, these distributions, the dividend yields, aren't as high as YieldMax ETFs or some of the other players, especially from Roundhill's weekly pay ETF lineup or the new Defiance ETFs. But what you're going to get with these ETFs from NEOS are going to be more consistency, more stability, and capital appreciation. A lot of these new ETFs coming out, we really want some stability in the NAV. We don't want to constantly reinvest our distributions back into the fund, because our goal ultimately is to use those distributions, use those dividends to pay off our bills and retire early, or just for retirement for most people. Now, if we head back to the N-1A filing, there are a ton of pages in this document, and it can be a little bit hard to read. So we will try to summarize it and explain it as best as we can. Now, if we head over to the principal investment strategies of the fund, it's an actively managed ETF. We're going to be seeing similar expense ratios, likely about 0.68% to 1% expense ratio. That's pretty much the norm for most of these ETFs. BTCI has a 0.98% and QQQI has a 0.68% expense ratio, just for reference. So we can see something along the lines between those expense ratios, and that is something to keep in mind because it can be a little bit expensive, but that is just the cost of actively managed ETFs. And it's basically going to seek equity long and short strategy, where the fund takes both long and short positions in mid and large cap US exchange traded equity securities, while also employing an options strategy to generate that high monthly income. Now, if we take a look at the long portfolio, it's going to have between 25 and 35 listed companies. So it is going to be a little bit more diverse than ULTY, which is going to hold between 15 and 30 companies. So there's going to be a little bit more diversity in this portfolio, and it's not limited with respect to the size of position in a single issuer of equities. And we also want to note that it's going to limit any single position to a range from between 3 to 7%, so it's not over leveraging in one single company. So that's going to be good for diversification. And when taking a long position, the advisor relies on a bottom-up approach to determine whether and when to buy and sell equities. So it's entirely up to the fund manager, and it's going to select equities that in its view have the best expected returns based on a mixture of factors, including quality, earnings, and cash flow. And I do believe that they should be able to choose some solid companies. I hope it's not as speculative as ULTY. That would really make this ETF very distinctive and solid in terms of NAV. And this fund is not going to be day trading. It says after it sells a portfolio security, it will not purchase the same stock or company for at least 30 days. That is also very important for taxes, so you're not subject to the tax wash sale rule. And we'll get into tax efficiency with this ETF in a little bit as well. Now onto the short portfolio. It's going to comprise of the same amount of companies, 25 to 35 listed companies. But the difference is it's going to have a smaller position on the shorts. So it's going to be between a range of 1.5 to 3% for each of those short positions. And it's going to analyze these companies to short when the advisor believes it has poor cash flow, weak balance sheets, and adverse conditions impacting a sector, as well as other factors that could potentially indicate negative performance. So this is going to be a very interesting ETF, combining both the long side and the short side. And as we can see with the long and short mix, it's going to maintain a gross exposure of at least 80% of long and short mixes. And the fund anticipates exposure will be about 120% long and 55% short. And it's going to rebalance the strategy weekly, monthly, or quarterly based on indicators, and it could rebalance more frequently to reduce company or industry specific concentration or other risks. So it all sounds really good. It sounds like they're going to choose some solid companies. They're going to analyze the companies to see whether to be long or short, and they're going to rebalance in a very effective way. Now we do have the most important part of the fund, which is going to be the options strategy, and that's going to be how this fund is going to generate monthly cash flow. And what they're going to do is the options strategy is going to utilize a put spread, which is going to consist of the sale of exchange listed put options and the purchase of the put options. Because remember, a put spread is when you sell a put and buy a put at the same time. And they are going to do this, I believe, on the S&P 500 index, SPX. And because they are doing it on SPX, these contracts are going to be tax efficient. So you're going to have it classified as Section 1256 contracts. And under these rules, you're going to have 60% long-term capital gains and only 40% short-term capital gains, regardless of how long the contracts were held, which is very distinctive for NEOS because they really utilize these 1256 contracts in a lot of their funds, making them more tax efficient, making them better for retirees who are relying on the income from these funds and don't want to pay as much taxes. So this is very good to see that they are utilizing tax efficiency and keeping the investors in mind. Now, if that was a lot of text, hard to read, we have summarized it with AI. And basically what the fund is going to do, we're just going to quickly summarize it. It's a long and short equity income ETF. Also, before we get into that, we do want to mention that it will come out 75 days after this filing, and it was filed September 18, 2025. So we can expect this ETF to come out around December time. So we do have 2.5 months away, but keep this ETF on your radar. Time flies by super fast. And this ETF is going to be maybe one that you want to buy before the Christmas rally. But getting back to the summary, though shortening the SEC filing, we can see it's in a long and short equity income ETF. The goal is to generate high monthly income in a tax efficient manner with potential for equity appreciation. And I do believe because it has that long and short income mix, we are going to maybe see some NAV stability even during bear markets, but we do have to know this is all speculation, and we don't know how it's going to perform until it becomes released. And then just to recap, the long portfolio as well as the short portfolio are going to contain 25 to 35 US listed companies. They are going to have more of the long side rather than the short side, so you are going to be better off in bull markets because it has more exposure to long equities. And then the put spread strategy with SPX is going to be tax efficient, and it is going to be the way they are going to generate income. So you are going to get exposure to the S&P 500. If that index does well, this ETF is going to do well as well. And for tax treatment, as you mentioned earlier, 1256 contracts, 60% of the gains are taxed as long-term and 40% is short-term, regardless of time frame. And it may engage in tax loss harvesting strategies when possible. And that is important for the long equities. As you mentioned earlier, they're not going to rebuy the same companies within 30 days because that would get rid of the tax loss harvesting due to the wash sale rule. So there are going to be risks with this ETF as well as any ETF in general, but for this ETF, it's non-diversified, meaning larger relative exposure to individual issuers. So unlike an index such as SPY, the S&P 500 index, you're going to have 500 companies in that ETF. But for this ETF, it's going to be 25 to 35. So it's a very small exposure to individual stocks, and that can be a little bit risky. But we see this with ULTY with 15 to 30 different companies. And in my opinion, these types of ETFs are better than the single stock ETFs, such as MSTY or NVDY, which are reliant on that sole company. And in my opinion, the biggest risk is going to be new fund risk. We have a ton of ETFs coming out by a lot of different ETF issuers. And the main problem is there's no track record. A lot of people like to invest in stuff that has been out for a few years, but because a lot of these products are so new, there's no track record, and it's uncertain whether the fund will attract sufficient scale. But who should be interested in this ETF? It could appeal to investors seeking high current income plus some equity upside with tolerance for complexity and risk. In my opinion, it may be more risky than something like QQQI, or could be similar, but it's definitely going to be more risky than SPY, which is based on the S&P 500, which in my opinion is going to be the most stable of their ETF lineup. But I think a portfolio containing QQQI, BTCI, which is the Bitcoin high income ETF, and SPY, as well as with this long and short equity income ETF, it could provide a really nice balance between a 4-fund portfolio. And we will be making a video on that when that new ETF gets released in December. So keep an eye out for that. And if you're just as excited for this ETF as I am, let me know down below what your thoughts are. Is this going to kill off ULTY and SLTY? In my opinion, it's not going to kill those ETFs. This is just another option for investors to invest in. It could perform better, it could perform worse. I think that this ETF is not going to have as high as a distribution rate as ULTY and SLTY. I'm going to guess it's going to be between the 20% range, maybe 25%. That may be a little bit high. NEOS is usually on the conservative side for the yields compared to other ETF issuers. Let me know down in the comments what your thoughts are.